All right, everybody, welcome back. This is a very critical update on the long-standing Lunch and Learn webinar series that we've been hosting here at Zacks. And July has been a doozy. This is something that I've been talking about for quite a while. If you've been following us here, I have been warning about negative trends in the economy for some time. And I believe the time has now come for everybody, really. Especially if you are a client of ZRS or Zacks Advisor Tools, or in general a client of Zacks, we'd love to start taking a look at the Zacks Earnings Certain Proxy. And this is our flagship model portfolio that I directly manage myself here at Zacks. And this portfolio, I believe, is the time has now come after 2 consecutive years of lagging the market quite significantly, both in 2023 and so far this year in 2024, although the gap has narrowed this year. I believe the time has finally come to allocate into the Zacks Earnings Certain Proxy. And let's take a look exactly as to why I believe that now. So economic risks are rising. The probability of recession has increased, especially since we got that July non-farm payrolls report last week. Market volatility as a result is increasing. Remember, there's a number of risks that I've been highlighting for many months now, which is that it's been a combination of very high concentration. Remember, the majority of returns that we've seen in the market on the S&P 500 have been attributable to basically the top 10 and really the top 6 companies, and the top 10 now dominate 35% of the market index in terms of its weighting. And that is an all-time high. So we've never seen concentration in the top 10 to this extent in history. And that is presenting significant risk. And as we started to see this past couple of weeks here, market volatility is increasing. I believe that that type of outperformance, because of just a handful of companies, is not sustainable. And we've seen evidence that in the past, whenever market returns are that concentrated among the top holdings of the index versus say the equal weighted index, that has been a harbinger of bear markets. We saw that happen in 1999 to 2000. The last time the S&P market weighted index outperformed the equal weighted index to this extent, which is around 25% at the peak. The last time that happened was in 1999 to 2000. Not saying that has to happen again, but we deal with probabilities. Since none of us know the future with total clarity, we don't know whether this is an incoming recession or not. We don't know whether this is a harbinger of increased market volatility and an S&P market drawdown. But we can deal with probabilities given what we have noticed in the past. And, with the following charts that I'll present to you, the probability of recession has almost assuredly increased from this time last month when we last made an update to now. And that probability, I believe, has been systematically rising for the past 6 months. But we have a solution that is specifically built for this purpose. The Zacks Earnings Certain Proxy is built precisely for these types of environments that provide some durability to high volatile environments through all different types of macro environments. Let's take a look exactly what that is. So here is a sample of companies that we hold in the portfolio. These are, what we have identified from the market. We look at basically the entire large cap space in the US, and we filter down based on which companies have had a track record of low volatility earnings growth over time. That is the key there. A lot of other strategies focus on low volatility in terms of price. We don't look at that. We like to look at low volatility earnings. So basically companies that compound steadily over time across all macroeconomic environments of the past 20 years or so. And these are just a few of the companies that make that list. And as you can see, just looking at a couple of them, Novo Nordisk, Mettler Toledo, Intercontinental Exchange, ICE, Amgen. These are companies that produce products and services that are always in demand. They don't have, waxing and waning demand based on the business cycle. They don't have higher or lower demand based on interest rates. They don't have higher or lower demand based on the strength of the dollar. Their business is entirely based on serving the needs of a population which are always in demand across all macroeconomic environments. M Smucker very clearly, right? If you have kids, or even if you were when you were once a kid, I'm pretty sure you had their peanut butter, right? There's the Smucker peanut butter. M Smucker has been around for generations and will most likely be around again for another several generations. And the entire time they have compounded earnings with very little volatility. And if you can imagine all the different types of ups and downs we've had for the past 50 years, M Smucker has lived through it all, they've navigated through it all, and the end result is very steady state earnings growth over time. American Tower, another phenomenally well-managed company. This is a real estate investment trust, but what they do is they own hundreds of thousands of mobile towers all around the world, all throughout North America, South America, India, and many other parts of the world. They own, plots of land where they build towers, and they lease these towers to all of your household mobile carriers like Verizon, AT&T, T-Mobile, and others, other big ones throughout South America and India. And so therefore they produce very steady state lease revenue. And many times, in fact, almost all the time, these lease agreements extend out between 5 to 10 years. So that provides a level of stability and forecastability and predictability many, many years out into the future. And so therefore, this is a company that is, resilient to recessions. Same with Clorox, Intercontinental Exchange. They own the New York Stock Exchange, among other exchanges. The exchanges never lose money. They are the house. So, as long as we have a stock market, the New York Stock Exchange is going to continue to print earnings, and that grows over time, especially as volatility increases. They're actually a beneficiary of that. So their earnings are basically immune to recession. Same with Costco. Costco provides, a very large amount of consumer staples that the population depends on. And because of their cost-efficient, supply chain management, they are able to pass these savings on to customers. So vast segments of the population depend on Costco for cheap, affordable groceries and other staples. So this is exactly the type of business that we look for: high quality, recession-resistant companies with durable moats. Remember, these are moats that we look for as well. Companies with strong brand value or strong network effects, like in the case of ICE. That is a case where network effects, prevent competition from coming in. And as we know, there are only a few stock exchanges that are truly competitive, and ICE is one of them. So there's very little competition for ICE as well as Costco. Almost no competition for Novo Nordisk in the spaces that they operate in, both in diabetes management and now in weight loss, drugs, these so-called GLP-1 class of drugs. And there's a lot of excitement and optimism around what other indications they can go after with that GLP-1 platform drug. So, platform drugs are very, very lucrative because the base, formula can be applied to various different indications, not just one. So as they, continue their R&D pipeline, they, are working on other applications to that GLP-1 drug that currently treats obesity, but, may, get into other factors as well. So again, Novo Nordisk, another phenomenal example of a deep R&D moat in that case. and they have the advantage of scale, just like Costco does. So these businesses, once they achieve, success, it's very difficult to supplant that, by the competition. Clorox, another household name that's withstood the test of time for 100+ years. They aren't going anywhere. Our grandparents use them, and so do we, and so will our grandchildren. So that, again, is the type of company that we look for: durable moats, low volatility, steady compounders. So what do we mean by steady compounders? What does that look like? So here's a chart of exactly what that looks like. Look at Checkpoint Software, one of our companies. Look at their earnings growth. I actually don't even pay attention to the stock price. We look at that last. What we would like to look for first are evidence of fundamental business durability. And the way we define that is steady state earnings growth. Look at that over time for Checkpoint. This is essentially a 45-degree lineup. Same with Cencora. This is previously known as AmerisourceBergen. They are the largest drug distributor in the world. So their services are a requirement for the population as long as we have prescription drugs. Cencora is at the center of that as the primary distributor of these drugs, sort of the middleman, if you will, between the drug manufacturers like Novo Nordisk and the end dispensaries like the pharmacies, the hospitals, the clinics all throughout the world. So they are the distributor of these prescription drugs, and look at just their revenue growth or earnings growth over time. It's just been absolutely phenomenal. These are well-managed businesses. They have lived through all sorts of environments, and as a result have been battle tested. As you can see, they didn't even have a recession in 2008. The last time we had that great financial crisis, there was no financial crisis for these companies. So these are the exact types of companies that we own in the earnings certain portfolio. And this is what it looks like as a whole. This is a composite of all 70 companies that we hold in the portfolio. And as you can see, the earnings growth of these companies over time are just highly durable and built to last. We believe that, this portfolio will outperform over a complete market cycle. When you go through a full bear followed by a full cyclical recovery, we believe in our core, in our heart of hearts, that this strategy, which is oriented around quality, around durability, around consistency, around needs-based versus wants-based, this strategy, I believe, will ultimately withstand the test of time. And I believe that because we're at a critical juncture now, where risks are beginning to build for the S&P 500 and the NASDAQ, I believe now is the time to take a hard look at this portfolio. And it's done quite well during the last 12 years that we've been managing this portfolio. It has underperformed the S&P. However, keep in mind, the last 12 years has been, one of the most spectacular bull markets that we've had in our lifetimes. And if this portfolio, which is built around defense first, can still keep up with one of the greatest bull markets of our lifetimes, then imagine what it will do once we actually get a true secular bear market. And I believe now that the probability of recession has increased quite materially, especially from this last jobs report. So the takeaway here is that now is the time to take a hard look, at the earnings certain proxy. This is a portfolio that is built with long-term durability in mind. Companies that have withstood the test of time, companies that have navigated prior recessions, companies that have navigated prior inflation cycles, companies that have navigated prior currency cycles, and everything else in between. And as you can see, the net result of that for these past 20 years or more has been steady state growth over time, regardless of what's happening. So because the probability of a downturn, or at least heightened volatility, heightened risk has increased, now is the time to take a strong look at the Zacks earnings certain proxy. So why do I believe that the probability of recession is increased? Here we see an update from including the latest jobs report from July. The household survey, while the headline number, which is the non-farm payrolls, has been strong, the household survey has been telling you a different story. And remember, the difference between the two is that the establishment survey counts the total number of jobs, so they survey employers. The household employment figure surveys households, so individuals. And the difference between the two tells us that many people are holding multiple jobs. And that's why you see on the household side, we had spectacular, rebound on a year-over-year basis exiting COVID. And so we saw a little bit of normalization of that, which is fine, which is completely normal. But you can see that it didn't just stop there. We continued to decelerate in these last 6 months. And now we see the household survey employment growth slow to essentially stagnation. And at no time in any prior bull market cycle, throughout the 2010s, throughout the 2000s, throughout the 1990s, throughout the 1980s, at any point outside of these shaded recession regions, we have never seen the household survey enter contraction. And I believe that now we're about to see that. We've been decelerating here. We finally cycled out of that insane period of COVID. So 2023 was the first year where we finally got the year-over-year comps out and cleared out. And so now the numbers today versus where we were last year is a true comparison after we have normalized from COVID. See, a lot of people still think that we're still normalizing from COVID. I believe that's not the case anymore. We've had that time all of last year, but if payrolls are continuing to shrink, at least on the household side, that is a major risk to keep in mind. So this is why I say that the probability of a recession has increased materially. Now, we can't say that for sure. We don't know for sure until the NBER calls it, the National Bureau of Economic Research. They will make that ultimate determination. But remember, the market doesn't wait for them, right? The market waits on when it believes that the probability of a downturn has increased. And that is what I believe the market has started to do. As we saw in this very heightened volatility period on Monday of this week, as well as heading into Monday from last week after we got that jobs report, I believe that something is churning, and we will see where that ends up. But there's other things too that are concerning as well. This is again the reason why I think that the probability of recession is increased. The unemployment rate surges to 4.3%. That crosses above the 3-year moving average. If you look at it, every time we've crossed above the 3-year moving average, we have been in a recession in the next 6 to 12 months. And the market is ready to price that in. If it sees that there is a heightened probability of recession, it starts to price that in today. And that's what I believe has started to happen. Again, probabilities, not certainties. Here we see permanent job losers. That also crosses above the 3-year moving average. Again, every single time that's happened, we have been in a confirmed recession 6 to 12 months later. And this is very important because a lot of people say that, well, the unemployment rate might have been affected by the hurricanes that are affecting Texas. Well, permanent job losers is not affected by that. Temporary layoffs are not counted in this figure. This is exactly as it sounds, permanent job losers, not temporary job losers, not temporary layoffs. So these are when employers permanently cancel jobs, not just a temporary layoff. So if this number is rising, that tells you that there is some movement in terms of employer layoffs. Here we look at the total unemployed. The total unemployed population has now soared 1.3 million over the past 12 months. This is now well above that 3-year moving average. And just again, check out exactly every single time this crosses above the 3-year moving average. We have been in a confirmed recession with no false positives. No false positives here. Same thing with the unemployment rate and the permanent job losers, no false positives. Again, probabilities have increased that we are in recession because of this. And by the way, the reason why this works is because unemployment is, by its very nature, a momentum-driven phenomenon. If you just think about it from first principles, let's say, let's say XYZ person gets laid off from his job. Well, that person then no longer patronizes the Uber or Lyft that he took to go to work. That person no longer patronizes the little cafe that he goes to for his cup of coffee every morning. He no longer patronizes the other restaurant that he goes to for lunch every day. He no longer patronizes the Uber or Lyft back home at the end of the day. And, that's just one person. And then if you compound that, right, another person gets laid off. They also don't take an Uber. So at the margin, that is lost revenue for all these little, places that they patronize on a regular basis. And they modify their vacation plans. They modify their other plans. They, instead of taking a big vacation, they take a slightly smaller vacation. This impacts, decisions at the margin. And that is what reverberates throughout the economy. And so the people on the receiving end of that, they put in slightly a smaller order to their suppliers than before. So that restaurant that he doesn't go to anymore, the next time they place an order with their supplier, it's that much less food that they order, which then affects the supplier. The supplier then has to make an adjustment, and this compounds and sort of acts as a domino effect throughout the economy. And that's exactly what we are starting to see here. And that's why when these crossovers happen, they don't just cross and then stop and then come back down. Historically speaking, when they cross over some level of a threshold, some type of threshold, not saying that 3 years is some magical number, but, this is just a way that we can assign a probability and say that the probability of recession driven by, cascading unemployment has increased quite materially, as it has in the past, as it happened in the past. So again, that is something that we cannot ignore. The number of people that are unemployed today versus 12 months ago is up 1.3 million. That level of increased unemployment is going to have an effect on retail sales and other parts of the economy that consumers patronize. JOLTS, another measure. This measures the total number of job openings. This is still up, right? This is actually one of the bull cases where we're still well above the peak of the pre-pandemic era. The post-pandemic era was a crazy multiple standard deviation move to the upside, and now we're just simply normalizing here. That could be very well true. So far, this number is not yet super concerning, right? But the trend is down. The trend continues to be down. And we need to see this number get arrested at some point and continue the recovery. But keep in mind, it's also below pre-pandemic trend. If you look at this, during the 2010s, and if you extend this out, it almost crosses through this line right here, which is the 3-year moving average anyway. But if you were to take an even more conservative look, maybe that number crosses through right here. So we are below trend. And every time we get below trend, that has been historically an indication that we are entering a jobs recession. And that's what we have seen in the past here. Every time it crosses below the 3-year moving average, but even if you look at it based on trend growth, we are also below the pre-pandemic trend. Job openings, as we just saw, and quits. The quits rate is also very important. They're also now below trend and in contraction year over year. The quits rate is very important because this tells you consumer behavior. This tells you the behavior of workers. Are they leaving their jobs at a high rate, or are they holding on to their jobs at a high rate? And here we saw during the height of the post-pandemic reopening, we saw a lot of labor mobility. As we saw here, all-time highs in the quits rate, 3% quits rate, which is quite high. That's way higher than we've ever been in the last 25 years. And that tells you that, workers felt empowered during that time. As this number rises, it means that more and more workers feel empowered to switch jobs, to get better jobs, to get better paying jobs, better benefits, things like that. But now look at what happened in the last, since then, in the last 2 years. But now we're in a ballpark that is not only below the trend over time, but down year over year, and in the ballpark of recession, at least in 2008. Now, it's still in the early innings. As you saw here, in the early part of the recession, the quits rate was still at around 2%. It was actually at 2.1% as well, precisely where we are right now. So if this number continues to drop, this is going to get very concerning. But the trend is what's concerning. The trend is in contraction. The trend continues to drop. And if this falls below 2%, again, I believe that this is yet another indication that the probability of recession has increased materially. Because as workers start to see fewer and fewer job openings, they tend to leave their current job less frequently. And that's exactly what we are starting to see here. So we're now below that level that we were pre-pandemic. And really, it's the rate of change that is the most important thing to watch. This is the ratio of job openings to the unemployed. Again, we're at that pre-pandemic level, but again, the rate of change is what's concerning, and it continues to drop even through July. We're now at, this is the ratio of total private jobs to the total unemployed. And we're approaching that 1-to-1 mark. And so if this continues to drop, again, the trend is not, very, very favorable. If you look at it, in terms of the pre-pandemic trend, again, we're below that trend, and we're overall trending lower on a year-over-year basis. So again, it's not about comparing where we are today versus where we were in prior recessions. It's more about looking at where we are today versus where we were 6 months ago, where we were 12 months ago. Because remember, the S&P is priced on earnings growth expectations. And earnings growth expectations is a sequential number. And sequential numbers are dependent on how much people spent last year versus this year. And so again, if unemployment is rising, if more people are unemployed last year versus this year, if there are fewer job openings per unemployed person right now versus last year, that puts pressure on retail sales. And remember, personal consumption is 60% of US GDP. So these are not very attractive. These are not very favorable trends for the market. Here's the Kansas City Fed labor market conditions index. This is one of my favorites. This takes an aggregate of 24 different variables. Most of them are leading indicators of the labor market. And here you can see again, just as we saw for the other ones, every time the LMCI crosses below its 3-year moving average, we have been in a confirmed jobs recession with no false positives going back 25 years. And here we are today as well. And, again, I can understand the bull case. Bulls argue that, the pandemic has caused all sorts of dislocations in the labor market and in the job market. And so this is nothing but normalization. I'm sympathetic to that view, but I don't think that you can continue to make that case now after 2 years of exiting the pandemic. It's just not, what I believe can be continued. That just can't be the excuse, this far out of the pandemic at this point. So again, the LMCI, this is the most comprehensive index of leading employment indicators. Total of 24 readings. This also includes permanent job losers, which I cited, also uses the quits rate and job openings to unemployed. So all of these factors that I showed you before, they're all compositized in this single series here. So all of them together are flashing elevated probability of recession. Aggregate payrolls. So here's another thing that I do personally here at Zacks. the aggregate payrolls versus the leading cyclical employment index. So this is an index that I personally maintain. This looks at 6 different industries. I don't look at the aggregate payrolls because remember, the total non-farm payrolls can include things like government jobs, healthcare, and education jobs. These are all non-cyclical sectors. They're all connected to government in some way. So they're not necessarily indicative of the truly private cyclical economy. So I like to look at only the industries that have historically been highly sensitive to the business cycle. Industries that shed jobs only during recessions and start to add jobs only during secular bull markets. And I found 6 such industries that have that leading edge to them, where they start to cut jobs ahead of the ahead of the aggregate, data. And as you can see here, these collective 6 industries entered contraction in terms of total headcount, almost 6 months in advance. Over here in the 2008 recession, this cut went into headcount reduction almost 12 months in advance. Today, we're now at the 14th consecutive month of contraction. So this time has been much longer, right? And that goes to show that, the bulls who contend that all of the labor market dysfunctions are causing these numbers to go haywire, right? That's really the true culprit. And they're right to that extent. And that's why this has been the longest contraction within these 6 cyclical industries without getting the aggregate payrolls into contraction. But here's the thing. I believe that this continues to be in contraction, even though it looks like it's starting to curve up. That's because the year-over-year comps are getting more and more difficult. And July was yet another decline in the total headcount among these 6 industries. So the takeaway here is that the longer this remains in contraction, the increasing the probability of recession, that this number will eventually catch down to that. So if this recovers, then I will say that, that was a moot point, that was an incorrect forecast. But the longer this remains in contraction, it's now been 14 months. Eventually what this does is that the rest of the economy catches down to that. And so here are those industries: plastics and rubber manufacturing, building material and garden equipment dealers, trucking, administrative. So all these sectors, they have a long history of shedding jobs ahead of the broader business cycle because they're just inherently more sensitive to changes in aggregate demand than other more durable industries such as education, healthcare, and government. So it's very important to track these 6 specific industries and how they're hiring or firing, because they have their pulse on the cyclical economy a lot closer than everybody else. And these are very important industries. They're not marginal industries. Residential building construction, trucking is huge. In many states, trucking is the number 1 job category. Plastics and rubber products manufacturing. These are very important input industries that support the U.S. economy. So, this is something to watch very clearly. Full-time jobs, they rebounded huge in July, but they're still down year over year. And keep in mind, this is the 6th consecutive month of full-time job contraction. Again, that never happens during bull markets. So again, this is why I say that the probability of recession has increased. And the longer it stays in contraction, the more the probability rises. That's the way that I like to think of things here. Average weekly hours, they're also in rapid decline, down to 34.2. This is average weekly hours of all employees, total private, continues to march lower and lower. We're now basically at that threshold that we were in 2008. And by the way, that was in the middle of that recession when we got this low. So that recession had already started, by the time we were already at 34.25. So, and here's the other thing too, which is very important. The monthly non-farm payrolls might be overstating the actual jobs created. So if you look at the non-farm payrolls, even after the negative revisions, For 2023, on paper, the BLS reported over 3 million jobs created. But then when the quarterly Census of Employment and Wages report came out, QCEW, the actual jobs made last year was only 2.3 million. That's a delta of 23% to the downside. So that's substantial. These types of disconnects don't happen outside of recessions. And the reason why this is very important is because the QCEW is the most comprehensive job tracker we have. That covers 95% of all U.S. workers across over 12 million employers. And that's the reason why it comes out with a delay, is because it obviously takes a lot of time to tabulate all of those surveys. But it does cover 95%. It is the most thorough and most accurate jobs report that we have. And it told us that, the actual number of jobs created last year, way below what was reported. And it continues to do that in Q4. Even in Q4, the Business Dynamics report told us that instead of this 464,000 that the monthly non-farm payrolls report told us, it was actually 344. Still growth, still not bad at all. But remember, the key is that these types of deviations don't happen outside of recessions. And here's a chart that shows that. This takes a look at, I compiled this from the BLS website. This looks at the negative revisions or positive revisions, the total revisions over the last 12 months. So this is a third minus the first estimate delta on a trailing 12-month basis. So the sum total of all revisions, up or down, over the last 12 months, from the third estimate, which is the final estimate, to the first estimate. And look at what the delta is here. This is a major negative revision. And check out when exactly we get these types of negative revisions. Usually in recessions, at least at this extent. At this extent, it's usually in recessions. We're almost at, let's say 350,000 jobs in terms of negative revisions here. The last time we had, revisions of that size was during COVID, and prior to that, during the 2008 recession. And prior to that, going back to the 1991 recession. This could be a false signal, as you saw here in the 1980s. We had negative revisions quite substantially back then too. And that was not a recession during those years, 1985 to 87. So it could be that this is another false signal, but again, we talk about probabilities, not certainties. So the probability of a negative surprise has increased. Because remember, this is certainly not a good thing. At the very least, if there's one thing I can say with certainty, it is that it's not a good thing to see negative revisions to jobs. So again, this is consistent with prior recessions, and that's why the risk or probability of recession, in my view, has increased quite materially. And we're starting to see the effects of that on other data series. So the rising unemployment is already being felt in consumer behavior, despite still very low 4.3 unemployment. Remember, it's still low, but rising. And so the rate of change of that, the delta over 6 months and 12 months, starts to have an effect on consumer behavior. And we see here that personal savings is at a cycle low. It's well below long-term trend. The San Francisco Fed has published a great report talking about this, that all of the excess savings that individuals built up during the pandemic have basically been exhausted now. I believe that's primarily due to inflation eating away at incomes. So personal savings have basically been drained and well below long-term trend at this point, right as unemployment starts to snowball. If this starts to rise, consumers are entering a period of heightened and increasing unemployment from a weak starting point, which is very low level of savings, both in dollar terms and in the savings rate. Retail sales are down 1.6% in terms of real retail sales. If you take a look at the inflation-adjusted retail sales, it's down 1.6% over the past 2 years. So cumulatively over 2 years of time, real retail sales are down 1.6%. And it's down in 15 out of the last 20 months on a year-over-year basis. So this tells you that people are not buying more. They're just paying more. And they're actually buying slightly less because of that negative 1.6% number cumulatively over 2 years. And as we just saw yesterday, the New York Fed put out an update for Q2. Delinquencies continue to be on the rise. Credit card and all auto loan delinquencies across all ages are rising and at levels last seen during the Great Financial Crisis. So again, these are all the reasons why I believe that the probability of recession has increased materially, and this ultimately is not the trend that we want to see. These three charts right here, the unemployment rate crossing above the 3-year moving average, permanent job losers crossing above the 3-year moving average, total unemployed crossing above the 3-year moving average. Again, these events have never been wrong. So I would not like to bet against that probability. That is the takeaway here. I really don't like to be betting against these types of odds. It's not to say that this is a guaranteed, slam dunk in terms of a recession, but probabilities is how we should always position our investments. And the probabilities are not in favor of the bulls right now. And so that's why, given these trends in all of these categories here, unemployment, delinquencies, retail sales, manufacturing, again, which has been in recession for 20 out of 21 months, depleted personal savings base, I believe we're now, in, or at least the probability of recession has increased. I would like to correct myself on that. I believe we're in recession now, but that's not guaranteed. That's not confirmed. I could be wrong, but the probability has increased. We won't have an official confirmation of that until the National Bureau of Economic Research officially decides that. But again, nobody knows the future, but we do know probabilities, and that is what I am seeing with regards to probabilities. At the same time, risks continue to rise for regional banks, non-bank lenders, or investment funds that are over-leveraged to certain problem areas of the economy, which are commercial real estate, which continue to be depressed, consumer loans, and slowing retail sales, as well as housing. I believe all of these figures are at risk, and anyone out there who might be over-leveraged to any of those, and if they continue to sink, then somebody out there might be entering a liquidity event or some type of distress that could be a catalyst for a sharper and quicker downturn. And so all these risks are there and continue to rise, but markets, I believe, are still not reflecting that. And that's why I believe that now is the time for the ECP. So these are the big four indicators that I'm watching. Again, permanent job losers crossing above the 3-year average, that happened. Unemployment rate crossing above the 3-year average, that happened. Falling 2-year treasury yield and crossing below the 10-year. This is the yield curve re-steepening. When that happens, again, probabilities sharply rise that there is going to be a market downturn. When that happens, that is not the time to be long high risk. So if all three of those things happen, and then of course the fourth, which is the ultimate confirmation, which is the S&P or the NASDAQ have a weekly close below the 200-day moving average exponential. That is the final tell. When all four of these happen together, again, probabilities, not certainties, probabilities are significant in terms of a greater, deeper, more prolonged bear market. That yield curve re-steepening hasn't happened yet, but it's getting awfully close. So again, the probability of a downturn is significant and increasing in my view. So I believe it's time to go into the Zacks earnings certain proxy. I am monitoring it very closely. Over the past month, the ECP 75, that's our flagship portfolio of 75 companies, is outperforming the S&P. We were up through last Friday's close by about 6%. which is, I believe substantial. The S&P, I believe, is down around 2 to 3% over that time. So I'm not taking just a single month and running with it, but I believe that now is the time to take a hard look at the earnings certain proxy, the ultimate portfolio built for durability and quality. So hope you found this helpful. I'd love to hear questions, love to hear your feedback. Please do send us an email at strategycall@zackspro.com, or give us a call at 1-866-794-6065. Thanks again, everybody. Talk to you soon.